So I think that the greatest type of investment opportunity is where there's a misperception or a market inefficiency where the market's not pricing an asset appropriately. And there's a lot of satisfaction in being able to identify an undervalued asset, but more particularly identifying why is the market mispricing it. And so it's almost this kind of intellectual debate where you can say, I know why everybody else doesn't like it. Here's why I like it. And this is why I think it's going to be a good investment. And I think that's really the crux of what we do and why we do it is it's pretty easy to just go into Bloomberg and run a screen for the cheapest companies that you can find out there. But it's a lot harder to really understand why it's cheap.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am your host for today, Nathaniel, as with my co-host, Dan Weiss. And today we have with us James Davolos from Horizon Kinetics. Thank you for joining us today, James. I'm going to just read off your bio here real quick, and then we'll just roll right into it. So James joined the firm in 2005 and currently serves as co-portfolio manager for the Inflation Beneficiaries ETF, ticker INFL, the Internet Fund, as well as several private funds and institutional separate accounts. He began his investment career with the firm in 2005 as a member of the trading desk and joined the investment team in December 2006. James began his tenure on the investment team as a generalist analyst, covering investment and research opportunities for various strategies managed by the firm. James received a BBA in finance from Loyola University in Maryland and an MBA from New York. James, thank you for being with us today.
Yeah, really happy to be here. Thanks for having me.
So James, we're just going to roll right into it then. Can you tell us how you came to Horizon Kinetics, what drew you to the firm, and what sets it apart from other investment firms?
Sure. Well, Horizon kind of found me. It was lucky. They had a job opening on the trading desk, and I wanted to be in New York. I wanted to be in value investing. And so the only way I could really get my foot in the door was to start on the trading desk back in 2005. And to clarify, the trading desk was basically order entry for the portfolio managers' orders who I now work with today. But I quickly realized that it was a really unique firm and that it was a really special place. And the firm had excellent performance and had thought leadership kind of throughout the era leading up to 2005 and then into the global financial crisis. But one of the things that really resonated with me when I joined and was ultimately able to transition into research was that Murray and Peter and Steve were disciples of Graham and Dodd and Warren Buffett and Charlie Munger. And I'd always been fascinated by value investing. It made a lot more sense to me where not only are you trying to buy a dollar for less than a dollar, but also the concept of having a bit of a margin of safety for value investing rather than I'm conservative by nature. I want to be able to quantify to the greatest extent possible my upside or downside. And I think that's why I lean so heavily towards value investing. And, I was of the belief that you could really put a lot of it into a spreadsheet and figure out the asset value. And one of the things that I love about this firm is that we're very holistic and pragmatic and understanding the many ways assets can be valued. And so it was a great fit and been really happy here for 16 years now.
Okay. So maybe you can delve into more for you on the personal side when it comes to your work, but can you tell us about what gets you excited in the world of investing? Is it a certain niche of companies? Is it a secular trend that you think everyone else is missing, perhaps in a particular industry or company, or is it something else?
I think being able to look further out and understanding a market inefficiency. So I think that the greatest type of investment opportunity is where there's a misperception or a market inefficiency where the market's not pricing an asset appropriately. And there's a lot of satisfaction in being able to identify an undervalued asset, but more particularly identifying why is the market mispricing it. And so it's almost this kind of intellectual debate where you can say, I know why everybody else doesn't like it. Here's why I like it. And this is why I think it's going to be a good investment. And I think that's really the crux of what we do and why we do it is it's pretty easy to just go into Bloomberg and run a screen for the cheapest companies that you can find out there. But it's a lot harder to really understand why it's cheap. And this isn't to say that we're necessarily all that concerned with when there's going to be a catalyst, but we do want to understand why it's undervalued. And I think that that is a much more important variable in generating long-term returns is understanding the value and why.
So I have a follow-up to that. You mentioned a catalyst. So it's not so much about thinking about when the catalyst is going to happen, but just having an understanding of that catalyst and the potential for that catalyst to, at some point in the future, execute. So that then brings up my follow-up question, like, what is your guys' investment time frame when it comes to how you view these catalysts, how you view investments in general? And then as a follow-up, what happens when, if for long periods of time, for whatever reason, the price is much lower than what you believe its value to be for an extended period of time? How do you balance that with your clients, with their needs? How does that compute?
Yeah, I'd say that one of the biggest ways we differentiate ourselves, hence the name of the firm, is we extend our time horizon. So we're looking to underwrite for a minimum 5 to 7 years. And best case scenario, we own something, we can own it forever and just let it compound for us. It's tax efficient and it enables us to really understand the company and all the drivers on a secular basis. So I'd say that that's really important because it's really difficult to understand when a catalyst is going to change the price of the security. And I think that in most periods, the catalysts kind of roll on a nice rolling basis throughout the portfolio. So it results in having performance that's acceptable, but where it can be at odds is it can be at odds with the broader market. So a good example would be this kind of era, probably the last decade, preceding 2021, 2022, when the markets were basically surging for 10 years straight coming out of the global financial crisis. And if you didn't own technology, if you didn't own long duration, high growth assets, it was extremely difficult to perform to that level on an annual basis. And so I think what it was really important to communicate to our clients that we didn't necessarily see attractive risk reward there, and that in the eventuality that valuation was going to become important again, we felt as though our time to shine would arrive and it would be prolonged. And I think that, we're finally reaping the benefits of that over the last, we've done quite well for the last 2 years, but I think our big breakout was year to date and 12 months relative to the market, certainly over the most recent 6 and 8 and 9 months. And I think that's important, is to understand when you should do well, communicate that. And fortunately, we are doing well in a period where we think we should. And so clients know that they own us to not have the market. And so if you communicate that effectively, they're willing to have different performance from the market, even over a prolonged period of time, understanding that when the right time comes, they should be rewarded.
So I got another follow-up to that. And you mentioned something about that we are not the market. Can you expound upon that? Like, how is Horizon Kinetics different from what other firms are offering in terms of that you are not the market, that you're not investing in the market?
Yeah, I mean, to borrow a term from my colleague Murray Stahl, once the wave of passive investing and even index benchmarking came, the world really became industrial scale in asset management because fees were going down, costs were going up, and so everything relied upon scale, and everybody was more concerned with their asset allocation, hence their performance relative to the benchmark. So if you look at 95% of global assets under management, it's very heavily beholden to the S&P 500, the MSCI ACWI index, the Barclays aggregate bond index, and then there's sleeves of that in value and growth and everything in between. But we actually prefer stocks that the indexes don't own at all. So not only are we really different from the S&P 500, which has become ultra concentrated in growth names, but we tend to skew small and mid cap in a lot of names that are underrepresented or not represented at all, certainly in the major benchmarks. And as I mentioned before, that's been a headwind in the era of passive indexation, when passive has gained more and more market share with every given day, week, month, year. But I think that when there is the eventual unwind, which maybe we're seeing today in passive, I think that sets a very nice stage for owning these types of companies on a fundamental basis as well as a market structure basis.
Yeah, James, that was fantastic. I'm thinking in terms of questions that we get from a lot of our clientele, of which a piece that we've talked to you about in the last probably 2 weeks is your thoughts on inflation in general, and more specifically, what that looks like on the entities that Horizon Kinetics owns.
And I think there's a big misperception about inflation today, where I think most people would argue that it's because of supply chain issues and a lot of money that entered the system in response to the pandemic. And that's true. Those are both half truths, but what we've really had is we've had a slow burning fire for the better part of, I would argue, all the way back to the gold standard in the 70s, and certainly going back to the 10-year bond yield peak in the early 1980s, where we've had declining interest rates, generally budget deficits, higher proportionate government debt as a proportion of GDP, and then ballooning government debts on top of that. And then finally, you had rising money supply growth. So with all of those variables going into 2020, probably that 10-year period, money supply growth was upwards of 6% a year. The overnight benchmark rate was 0 for most of it, and then we gradually got up to a couple hundred basis points. But inflation was still running at 1.5 to 2. And I think that if you have very cheap money, negative money in real terms, I think depending on how you look at what inflation is, coupled with money supply growth, it was readily apparent to us that inflation was going to break out at some point. And our view was also informed by the fact that we saw supply side issues forming well before the pandemic in a lot of raw materials, the quote hard assets that are inflationary today. So that was a long buildup to basically dumping gasoline on that slow burning fire in 2020 in the form of massive amount of money supply growth, at one point over 40% year over year. You brought interest rates all the way back down to 0. And as inflation started to pick up, we had the highest real negative yield in 10-year debt in the history of the country. And so I think that was the precondition for inflation. And I think that with that in mind, it's not going to be as simple as just hiking interest rates and quantitative tightening to try to kind of tighten monetary conditions and fiscal conditions, because there's 2 big variables that I think are going to be a long time in the making. One is that we've underinvested in supply of raw materials for the better part of 10 years. Certain industries for over 10 years, certain industries for 3, 5, 7 years. And these aren't the types of things that you can just flick a switch and write a check and get supply on today. And unfortunately, we're learning that very painfully in terms of the energy dependence of Europe on less than friendly nations for their energy supply. So but then the other new trend that's happening is a lot of the greener trends are going to require a lot more higher electrification of grids and modernization of grids. And that's going to require a lot more conductive metals such as copper, zinc, nickel, aluminum, but also iron and steel to basically build this. And all of these things are going to be inflationary as fiscal is tilted towards green policies, which are inherently inflationary. So that was a bit of a long-winded answer in saying we think that the seeds were sown for a very long time before the pandemic, maybe they're growing a lot faster, but they're also going to grow a lot longer given the structural issues. And so we're positioned in hard asset companies. So finite, tangible, high quality assets that are low on the cost curve with inelastic demand that are probably going to benefit from the supply as well as demand dynamics within broader inflationary forces on a secular basis. The one thing that we do that I think is different from everybody else is we overlay a capital light business model where we want to have operating leverage. So you don't tie up a lot of capital in the business, you don't use a lot of debt financing. And so that creates a much more scalable quality business where you can basically withstand a full cycle, which is going to be volatile. But more importantly, what you really want to capture investing in inflation is a inflection where you have revenue inflect without costs. So if your revenue line is driven by, call it price times production, but you have a fairly fixed cost structure or a minimal cost structure with no variable expenses, you have margin expansion. When the rest of the world, those long duration stocks that I mentioned before, they're having margin compression by virtue of inflation. And so that's why we think that we're in the early stages of this strategy, but also have a lot longer runway in what we think returns can be going from here.
So a lot to take away from what you just said there, which is what we expected to be the case. And so as you were ending that answer to speaking about what inflation is likely to do to particular companies' margins, I'm hearing you say, which is of no surprise, that clearly it's very important to understand what you're purchasing, what those investments really are from an entity standpoint, which is something we talk about quite a bit, although there could be commentary, I guess, inserted here as to not everyone considers that anymore, which leads me then to a thought of could you dig a bit into what your perspective or what Horizon Kinetics' perspective is relating to any concerns as referring to passive or indexing concepts where that may not be considered?
Yeah, I think in passive, again, I mentioned industrial scale asset management. So if your fees are coming down in the case of Vanguard and BlackRock, in the case of, single digit basis points, you need by definition massive amounts of assets under management to make your economics work. And the only way to do that at scale is to buy the largest and most liquid companies. And so as things go up, you buy more and more of them, and you don't really care about what is within the index. You care about scale and size. And what has grown over the past 20 years has been technology. So passive has flooded into technology, a bit of a self-fulfilling cycle here, right? Growing the asset values of tech, where technology is an outsized amount of the stock market. But then the raw material, so the materials and energy sector going into this year was barely 5% of the S&P. So these are the things that you really want to own, but because of the structure of passive and the markets themselves, you're structurally underallocated to the assets that you probably want the most exposure to right now. And so that's why I think passive is so dangerous, because no one was paying attention to that. It was simply autopilot based on market cap. Nobody said, let's increase energy, even though the market cap is less, just because it's such a critical part of the overall economy. They just said tech has a higher market value, tech has a higher price, tech has a higher weight, and that's how the index works. And these things, when done to excess, can be big problems.
Thanks, James. Great answer. Getting a little more specific on something that the fund has done. So Horizon Kinetics is one of the first firms to do serious research on all things crypto. What can you tell us about what you've learned and what your general thoughts on the crypto space and future look like or could look like?
The thing about crypto is that, everybody's saying, well, inflation's up 8% and Bitcoin is down or flat or somewhere in between. And you need to zoom out and look at the longer timeline. And the longer timeline shows that we've been debasing fiat currencies. And this is the dollar, the yen, the euro, the pound, to name the big liquid global currencies. But it's basically very similar for all of the developed markets across the world. And what I mean by when I say debasing, I mean, I believe that our interest rate that we're paying on debt is lower than the real rate of inflation. And we're running at enormous fiscal deficits. So by definition, we need to fund these governments through more debt issuance. And the only way out of that quagmire, absent a almost impossible to conceive growth and productivity, because let me just step back. The only way to grow out of a debt burden as large as we have today, not that long ago, it was 140% of GDP, depending on how you do the math, is higher GDP growth. Now, the identity of GDP is you need higher labor force participation, which that's structurally just not going to happen in the United States, at least enough to really boost growth to where it needs to be to grow out of 140% of GDP growth. The other identity of GDP is productivity. And sure, there's a lot of different initiatives in productivity, but even the internet, which has brought along just unforetold amounts of productivity growth, that times 10 wouldn't be enough productivity to basically offset to basically grow our way out of the debt the way that we did coming out of World War II. So absent those avenues, the only other two avenues to basically getting out of the debt issue are default, which let's just hope for a moment is off the table for all of those currencies I mentioned, or debase. And debase is simply you are offering an interest rate that is negative in real terms or very low in real terms. So the principal amount of debt you have to repay is a lot lower in the future. Within that context, I think there's a very compelling case to have a currency or a store of value that is finite, that provides a societal gain, and basically is hard money that the government can't just make a decision next week and print $1 trillion more of it. And so, without getting into the technical side of crypto, I think the hard money side is what is so compelling and what is a long-term correlation to inflation. But you can pick 3, 6, 9, 12 month, 1 year, 2 year, 3 year periods where that relationship breaks down. But if you zoom out over a longer period of time, I think finite issued store of value assets in the crypto space have, at a bare minimum, a lot of merit to think about ideologically.
So this brings up a follow-up question that I have, which is, so from going back to using, say, Bitcoin or other kinds of cryptocurrencies as hard assets, stores of value, when it comes to as a percentage of one's investment portfolio, do you have any thoughts that you would like to share from yours or Horizon Kinetics perspective to what that percentage range should be for the average investor?
It should still be very, very small as a percentage of your net worth, I think, no matter who you are. And I think where it gets tricky is if you were an early adopter and a very minuscule amount is now a majority amount. For a lot of people that were early adopters, where now it's the majority of their net worth. But from what you commit into it, let's say you have zero today, it needs to be an extremely small amount of money because there still is a tremendous amount of inherent risk. His thinking might have changed today, but not that long ago. Our chairman said, think about a vacation that you would spend, how much you would spend on a nice week-long vacation with your family. And imagine it rained the whole time, the kids got sick, the hotel wasn't any fun, and it was an absolute miserable vacation. What's the number that you can live with on basically losing on a miserable vacation? And that's the number that you should basically be willing to assign to crypto. I think that number will go up with time as there is less risk and less uncertainty. And it appears that there's a lot of progress on the regulatory and the adoption front, but there's also some negative headlines as well. So I would imagine that his thinking hasn't changed that much. And I think that as a starting point, that should be where people really start out until they come to a higher or lower level of conviction based on their own work.
Thank you, James. That's great. One last question is, Horizon Kinetics' largest investment by far has been for a while, is Texas Pacific Land Corp. Why is this your largest concentration? And what are your thoughts or the firm's thoughts just on concentration in general? You kind of touched a little bit on it, but it's still different with the whole crypto question.
Yeah, so Texas Pacific Land Trust is a one-of-a-kind asset because it owns royalties in energy production, but it also owns the surface acreage. So there's a lot of companies that own royalties. And by the way, royalties in their purest form are 90% plus operating margin businesses because you're really just cashing checks. So somebody else spends a couple $100 million developing energy assets and you just get a check. So in Texas, they call it mailbox money because you literally walk out to your mailbox one day and there's your check. So it's the purest and best form of energy ownership that is out there. It also just so happens to be concentrated in West Texas, specifically the Permian Basin, but specifically the Delaware Basin within the Permian, which is really the largest untapped resource in the developed world today. So we think that probably at some point in the next few years, the world's going to recognize the Delaware Basin as the actual swing producer balancing global supply and demand. Once people realize OPEC might be closer to tapped out and not have spare capacity, and some other barrels are coming off the market for geopolitical or economic reasons. So you have the geographical and asset quality standpoint for you, but the surface land is what nobody really fully appreciates, where there's infrastructure where they get royalties on infrastructure, as well as a water business where the water is critical in removing the hydrocarbons, but also there's a lot of water in the earth which needs to be remediated. Those are known knowns, which can be valued with some degree of precision, but a high degree of imprecision. What the world doesn't know is you've got 900,000 acres of contiguous acreage over here. What is the higher and better use? And just in the last few weeks, they've announced deals to do a renewable deal, which is going to basically do behind the meter wind and solar installations to support crypto mining. They're involved in both businesses, but what I think is more exciting is the renewable energy, because Texas is a free energy market, the ERCOT grid. West Texas is uniquely flat, dry, and sunny. Very good for solar, unregulated power market. You can plug a lot of that in. You just need something installed to take off the intermittent load to make it economic. And I think that's why mining makes sense. The other area that they have a deal is there's an exploration agreement to do carbon capture. So the world is going to pursue net zero. Let's hope we get there. I think it's going to be a lot longer than people think. But one of the first ways to get there is you need to sequester carbon from energy extraction, but also refineries, cement factories, fertilizer factories. You sequester that on site, and then you need to basically remediate it under the earth. And what better place to do that than 900,000 contiguous acres in the largest energy basin in the world? So you look at all those variables in terms of quality, upside, optionality. I just really don't think the market appreciates it. And so when you look at what you're paying for that today, I think you can justify the valuation based on the numbers that are visible. Forget the numbers that aren't yet visible, which I believe are much, much higher than what's priced in. So that's why we love the asset. We continue to own it in massive size. And to your point about concentration, you go back to Warren Buffett again. He once said that you should invest like you have a punch card with 20 slots on that punch card, and every time you buy a stock, it gets punched. And that basically says you wait until you get the fat pitch and you have a great idea that you can really get behind. We think that this is a one-of-a-kind asset. It's really unique. It's trading at the right price. And so you need a couple of these throughout your career to have a phenomenal track record. And if you look at the really, really great track records of all time, so the super investors of Graham and Doddsville, to go back to the Columbia Business School study, every one of them was ultra concentrated at one point. Buffett again, Geico was, I think, at one point 60% of his book. But Walter Schloss, all these people, Munger, they all at one point had enormous concentration. It's only now that the academic world, the institutional world is pursuing, you need to have 8,000 stocks with different return drivers where you're guaranteed mediocrity the more you diversify. So if you're willing to do the work, pull up your sleeves and understand and find the unique assets, and you have the risk tolerance and the time horizon, concentration makes a lot of sense.
Thanks, James. I'll kick off with some thoughts, and I had like 5, but I'm not going to do that to everybody. So I'm going to narrow it down just to highlight 2 things that you said recently in this podcast. One of which is that you just said that today, at least, this over diversification is nothing but a path to mediocrity. And I think it's important enough, even though you just said that about 60 seconds ago, that be repeated. The other thing I want to throw back out there to highlight is the comment that you made from your chairman when related to what should my starting point be if I'm going to allocate money into crypto. I think it's really difficult for someone to wrap their head around what that can look like. Waiting in general is an art that is often lost among some professionals and unknown to people who are not professionals. So the comment is this again: invest what you're willing to spend on a miserable vacation. I think that's pretty close in summarizing on what you said from a starting point standpoint. So I will leave with those highlights and discard the other 6 to 10 thoughts that I could share and pass the baton to you, Nathaniel.
Yeah, I'm going to actually piggyback off of what Dan just mentioned about an appropriate weighting. And I think that it's very important to be stated because people, they get excited, they experience FOMO, and they see their friends doing well from crypto, and then they decide to pile a whole lot of money in, and then they lose their shirt. And it's very sad to see, but unfortunately it does happen. So it's great to hear from an experienced investor such as yourself that this is a real thing. Like concentration, you have to be aware of it, and you have to be aware of investing, of what you're investing in. And then I would just like to hit on just hearing you speak about Texas Pacific land. It is just a great example of what an expert investor should be doing, which is they should be researching these companies, understanding what's involved with them, understanding what comprises of them. And I think that most do-it-yourself investors out there are not anywhere close to doing that kind of work and research, and it puts them at a fundamental disadvantage. And conversely, it puts you at a greater advantage, and which is great, which is why people should invest their money with investors such as yourselves, in my opinion. So with that, I'll pass that on to you, James, if you want to close her up.
No, yeah, I think we've hit on a lot of great topics here. And I think that inflation, one thing I just want to leave everyone with is I think that the inflation debate is probably going to be raging on 10 years, 15, 20 years from now. But the fact that you need to look at it as the paradigm has shifted from an era of declining interest rates, low and stable inflation, and rising asset values. And it's shifting towards a lot of trends that are going to promote higher inflation, rising interest rates, at least for now, and higher volatility, meaning compressing asset prices. And so increasingly, I think that hard assets with the right business models, the right management teams, and the right valuations make a lot of sense. And at a bare minimum, I think it should be added to supplement maybe more conventional exposures that people have been in for years. And so it seems to make a lot of sense to us. And we'll see probably a lot more interesting things to happen over the next 3, 6, and 9 months.
Thank you again, James. Nathaniel and I always enjoy having conversations with you, and hopefully sooner than later we'll be able to see you again face to face. It's been a couple of years. So thanks again for sharing all this wisdom. And to our audience, over the years, we've been able to bring you wonderful guests because that's a privilege that Nathaniel, Tim, myself, and our entire firm has had, is to meet wonderful, interesting, intelligent people like James. And but we've not really until now brought forth a number of money managers that we've partnered with for a long time and want to share the reasons as to why we do that, not just from our mouth, but from them themselves, like James. So you'll see a few other money managers that we really trust and believe in to show up on the podcast. So James, thanks for kicking off that segment of the many different kinds of guests that we bring in. And audience, as always, thank you for tuning in. We appreciate your attention and your continued efforts to follow us. Have a great day and take care of yourselves.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.